Some thoughts to share with you today on why rates will likely fall a lot more than what the market expects. Now, this is some really interesting information from Edge Analytics that I thought I'd share with you because it's a bit different than what most other economists are saying. So today we'll cover the four main reasons why rates will likely fall a lot more than the market expects. The first one is inflation looks really stable. Although we saw a hot spot this week with inflation, generally core inflation is close to its 2% target. And it hasn't been that way in a while. The second reason why we think that rates are going to decrease a lot more than the market expects is because we have broken the psychology around inflation. And let me explain that to you. So it's kind of like a self-fulfilling prophecy. If we think that inflation is going to be a problem, what ends up happening is we end up buying the goods that we think are going to be higher priced in the next 6 months. And we kind of saw that with the cost of lumber and all of the people renovating during the pandemic. I saw some funny memes on Instagram where, someone was carrying a trailer full of lumber and they're like, hey, that's a millionaire. So we've broken that psychology where people are actually thinking that products are going to be more expensive in the future and then they're buying them up. And how that fuels inflation is that actually affects supply and increases the price of these goods. So this psychology has been broken. And when that psychology is broken, this idea of the self-fulfilling prophecy around inflation stops. And so that's maybe one of the reasons why we are starting to see some cooling in inflation is because there's not this panic around buying these goods that will be more expensive in the future. The third reason why we think the interest rates will come down more than what the market expects is the economy is actually starting to see some pain from high interest rates. Because of the interest costs and the cost of housing, consumers are pulling back on discretionary pricing. And so, we're starting to see some retail numbers. They are starting to slowly recover, but earlier this year, sort of the retail numbers on what people were spending has really is really in the negative. The fourth reason is that if the Bank of Canada doesn't lower interest rates, things will get worse if rates continue to be high. And we don't have in Canada, the US doesn't have the same problem as we do in Canada with interest costs and resetting of mortgages. So generally in Canada, mortgages are reset on a 5-year cycle. And the majority of mortgages coming up for renewal. So almost 65% of the mortgages that are coming up for renewal in Canada are coming up for renewal in the next 3 years. And so what that means is there's going to be a significant, there could be, well, what we're actually seeing is nearly a 40% increase on mortgage payments. So if the Bank of Canada doesn't adjust its interest rates, that will make it worse for the entire economy and the Canadian population. I also wanted just to make sure that I quickly review to you sort of the different kinds of influences on interest rates, and just in case your mortgage is coming up for renewal. So remember, there are different kinds of rates. There is the fixed rates, which are based on bond yields, the overnight lending rate, which the Bank of Canada changes, and that impacts the different banks' prime rates. And when the prime rate changes, variable rate changes, interest rate changes, credit cards and lines of credit. So again, if your mortgage is coming up for renewal, I always hear, the Bank of Canada is going to adjust the interest rate. Is that going to have an impact on my fixed rate mortgages? And what actually happens is there's an inverse proportion on that. So these are just some of the things that we're thinking why interest rates will go down more than the market expects. That'll be good news for you if you're renewing your mortgage. If you're sort of worried about your payments or are carrying a lot of debt, like credit card or line of credit debt, and you're in the middle of your term and you're like, oh, what should I do? There may be an opportunity just to improve your cash flow so you keep up with the payments and you maintain your credit history. I'm Sandra. I'm the principal broker with the Mortgage Center, and we love helping people. Um, if you'd like to contact me, I'm happy to schedule a telephone call or an online appointment. You can use the link below to do that. Have a great day. Talk to you soon. Bye.